1st August 2018, Charlie Limited, so the date is 1st August 2018, Charlie Limited, whose, hold on, there's a term here, functional currency, I'll explain that shortly, is the cedi, bought a property in Morocco for 40 million DH, sure that's Moroccan currency. The property had a 20-year useful economic life, so I'm sure we'll need that for depreciation or something, with no residual value estimated. On 31st July 2019, which, if you remember, is the company's year end from here, the property was revalued. So we have some IFRS 16 revaluation model here to 45 million DH. Then they gave us exchange rates. The exchange rate as at 1st January 2018 was 1 cedi equals 1.32 DH. 1st August 2018, 1 cedi was 1.25 DH, and then 31st July 2019, 1 cedi was DH 1.125. Requirement is in accordance with IAS 21 and IAS 16, how much should be recognized in the statement of profit or loss and other comprehensive income for the year ended 31st July 2019. So before we start, let me give a quick overview of the relevant portions of IAS 21 that you will need to know to do this question. So what does IAS 21 talk about? What is that standard even about? As you can see, the name of the standard is what? The effect of changes in foreign exchange rates. Now, as a standard, what this does is it gives us the accounting guidance on how to deal with cases where you have some foreign currencies involved in your transactions. How do you translate those currencies into the relevant currency, which I'll call presentation currently shortly? And what are the rules around determining which currency to use to report your financial statement? So the standard is IAS 21. Let's do a quick summary of the essential points, and it's called the effects of changes in foreign exchange rates. So this standard outlines how you need to account for your foreign currency transactions and your operations in financial statements. It also gives you rules on how to translate your financial statements into something called a presentation currency. Key takeaway point is that an entity is required to determine something called a functional currency. And I think last sitting or last two sittings, there was a question that said define functional currency, or either that or distinguish between functional currency and presentation currency. These questions, you shouldn't let them go, right? They are within your reach. Answer them, right? So determine functional currency. So first thing is you're required to determine the functional currency, right? So an entity is required to determine their functional currency for each of their operations if they can, based on what's the company's primary economic environment in which they operate and in which they record what their foreign currency transactions using what their spot rates. So an entity will have to determine their functional currency, which, take note, I said is what is the currency of the primary economic environment in which they do business. Now, apart from the functional currency, there's another currency called the presentation currency. The presentation currency, as the name implies, is simply the currency in which what the financial statements are presented. That's all. So if you prepare your financials in Ghana cedi is your presentation currency. If you prepare your financial statements in US dollar, then the US dollar is your presentation currency. So take note, functional currency is the currency of the primary economic environment in which the entity operates. Take note. But here, remember that when we say primary economic environment and functional currency, it is not necessarily the country in which the company is located. So take note of this. A company may be in Ghana where we spend Ghana cedi, or where Ghana cedi is our legal tender. but the company may be using US dollar or Great British Pound as their functional currency. What will happen for this to be the case? But even before then, remember that, let's say, a gold mining company is in Ghana, so these gold or even the oil and gas companies in Ghana, if their main product is priced in US dollar, then even though they are in Ghana, their functional currency for reporting purposes will be the US dollar. So apart from the currency of the primary economic environment in which they operate, the currency in which they have a predominant value or volume of their transactions can also be their functional currency. So if you're a gold mining company in Ghana and you are predominantly into gold mining, gold is priced on the world gold market using what? Dollars. So you have to prepare your financials in dollars as a functional currency. If not, you suffer significant foreign exchange losses. Imagine you're a gold mining company, then you have to price everything in Ghana cedi. Look at how unstable the cedi is. So for companies that, even though they operate in a different environment with a different functional currency, if what they deal in as a company is usually in a large volume in a different currency, then that currency can be their functional currency. So if you realize, if you check any gold mining company or even the oil and gas companies in Ghana, check their financials, they all report in dollars. Even though they are in Ghana and our functional currency in Ghana is the Ghana cedi, because these guys, a big volume of their transactions are in dollars, their functional currency becomes the dollar, right? Then when we come to presentation currency, it's what you've just decided to present your currency in, your financials in. This will matter in consolidated financial statements. It's not in your syllabus, but those in level 3, they have something called foreign groups. Under foreign groups, a parent can be in Ghana. A subsidiary can be in Ghana. The parent is in US. When the parent in US is consolidating the Ghanaian subsidiary, even though the Ghanaian subsidiary may have reported in Ghana cedi, the Ghanaian subsidiary have to translate its financials into the US dollar for consolidation purposes. So we'll say that the Ghanaian subsidiary has a Ghana cedi functional currency, right? But they have a US dollar presentation currency because of what? Their parent company. So this is it for functional currency and presentation currency, and that is the main difference. Next thing we need to know under this standard is, how do you translate, or what rates do you use to translate different amounts in the financial statement? So let me give you a quick summary. So foreign currency monetary amount should be reported using the closing rate. So closing rate is the rate as at the end of the year. Then this is for monetary amounts, foreign currency amounts. Then non-monetary items that are carried at historical cost should be reported using the exchange rate at the date of the transaction. So if it was bought 10 years ago, use the rate 10 years ago. That's what it means, right? The exchange rate at the date of the transaction. And then final one is what? This is, so we just said non-monetary items at historical cost. The next is what? Non-monetary items that are carried at fair value. Here the exchange rate you use will be the rate that existed. So the rate on the date when the fair value was determined. So these are the main things you need to know at the FR level for IAS 21. That's what the IAS 21 gives: two types of currencies, the functional currency and the presentation currency. The easy guy is the presentation currency. That is the currency in which the financial statements are presented. That is all. So the final balance sheet you see, the final income statement you see, if it's in dollars, then it means their presentation currency is dollars. Easy. Functional currency, however, is the currency of the primary economic environment in which the company does business. So where they are situated, what's the currency there? If that does not help, and a majority of their goods or services is in a different currency, then that different currency can become their functional currency, even though the primary economic environment may have a different currency. Example I gave was what? Oil and gas companies and mining companies in Ghana that report in Ghana US dollar, even though their primary economic environment is what? Ghana cedi dominated. Then I gave you rules, three exchange rates to use. And this is what you really need to remember. If it's a monetary amount, then use what? The closing rate. If it's a non-monetary item carried at historical cost, then use the exchange rate at the date of the transaction. So even if it's 10 years ago, 5 years ago, use that rate at the date of the transaction. If it's a non-monetary item carried at fair value, then use the rate on the date on which the fair value was what? Determined. This is what you need to know really under IAS 21. So let's go back to the question and let's use these rules. So we are told here that on 1st August 2018, Charlie Limited, whose functional currency, now it makes sense, right, is the cedi. It means either they are located in Ghana or, yeah, that's the main thing, or wherever they are located. If it's not Ghana, a predominant portion of their transactions are in Ghana cedi. That's why their functional currency is the cedi. Makes sense, right? Bought a property in Morocco for DH 40 million. The property had a 20-year useful life with no residual value. Then on 31st July, which is year end, the property was revalued to 45 million. So remember the rules I gave here: monetary amount, closing rate. That's all we are going to use here, right? Non-monetary items at historical cost will be the rate at the date of the transaction. Then non-monetary items at fair value, we use the rate on the date when fair value was determined. That's all. Let's come back here. Then they gave us exchange rates here. They said the rate as at 1st January 2018 is what? 1.32. The rate at 1st August 2018 is 1.25, and the rate as at 31st July, which is year-end closing rate, is what? 1.125. So the $1 million question now is, what rates do we use and how do we approach this question? No problem. Let's start. So here we know that what? 1st August 2018 is when they purchased the asset, right? So asset purchased. How much was this bought for? So purchased for what? DH 40 million. 40 million. Right? So we know this is how much they bought the asset for. Great. Then the property had a 20-year economic life. So even before we start doing depreciation, because we need to report in Ghana cedi, let's convert this amount to Ghana cedi. So ladies and gentlemen, which rate are we going to use? Take note, this is what, let's do this. This is interesting. They bought, what did they buy? They bought a property. Let's come here. It's a property, a monetary amount, a monetary item or a non-monetary item. You agree with me that what? It is non-monetary. It is a tangible, physical item, right? It's a property. So we use non-monetary item. The question is it at historical cost or fair value? Here they bought a property for what? 40 million. Clearly, if they've not said anything about fair value, then this is the cost. So if they bought it on 1st August 2018 and it is a non-monetary item, and I've said non-monetary items, you need to use the rate on the date it was bought, then let's just come and pick, if it's 1st August 2018 here, then we'll just come and pick the rate of what? 1st August 2018, which is what? 1.25. So we use 1.25 to translate this property into what? Ghana cedi. So we say translation to Ghana cedi. So what that give us? Here, it depends on how you do your math, right? But simple ratio and proportion. If 1 cedi equals 1.25, you can do it more or less divide. What will 40 DHB? So you can just say, okay, DH 1.25, this for those who are not sure how to do this, equals 1 cedi, right? Then DH 40 will be what you can solve for x if you like, right? But I like to do if more or less divide. So here it is 40, it's more than 1.25, so I divide by what? 1.25. And you can say what you multiply by 1, whatever. So my calculator, give me a second, let me pull this up. I'm using my phone. So 40 divided by 1.25 will give me 32. Please take note it's in millions anyways, right? So 32 million Ghana cedi, right? So 32 million Ghana cedi is the cost of the property, historical cost. And we are using what? The cost or the exchange rate on the date it was purchased. Perfect. Now, if we have the cost, do you agree with me that we can all go and do the depreciation? Because it said what? The property had a 20-year useful life with no residual value. So if you remember your formula from IFRS 16, we say what? Depreciation of any property on a straight line basis equals cost minus what? Residual value or scrap value divided by what? The useful life, right? So we determined the cost to be what? 32 million. They told us clearly here that with what? With no residual value. So residual value is clearly 0. Useful life, they told us here that it was what? 20 years. So divided by 20 years. So 32 divided by 20, 32 divided by 20 will give me 1.6 million. So my depreciation is 1.6 million per annum. So every year I'll charge 1.6 million as depreciation. Take note, the question is saying how much should be charged? Watch the requirements. Tell them how much should be recognized in the statement of profit or loss and other comprehensive income. So I know I found one thing that will go to P&L, which is what my depreciation charge for the year. But I'm not done. Hold on. If I have found the depreciation charge, I wish I could end here. But the question ends up telling me that what the property was revalued. Now, if it was revalued, let's do some quick recap of IFRS 16, property, plant, and equipment. IFRS 16 tells you that what? All items of PPE are initially, so give me a second. Let me do something quickly here. I initially recognize at what? Cost. Then under subsequent measurement, you have two approaches, either the cost model or the revaluation what? Model. So I'm trying to help you revise IFRS 16. Under the cost model, the property is carried at its cost, less accumulated depreciation, and less any accumulated impairment losses as determined under what? IAS 36, impairment of assets. Under the revaluation model, the asset is carried at a certain revalued amount, which is the fair value of the asset. And here, fair value be determined in accordance with what? IFRS 13, fair value measurement. When you have that fair value figure, then you will now depreciate the asset. So it becomes carrying value of a revalued asset equals the fair value or the revalued amount, less accumulated depreciation, and as usual, less accumulated impairment losses as determined under IAS 36, impairment of assets. So they have told us here that the property was revalued. So it means they are using the revaluation model. Before you can revalue, and take note, I'm sure you are aware that all revaluation gains initially go to what? A revaluation surplus sitting in what? Other comprehensive income. Subsequent reversals of revaluation will be a reduction to the revaluation surplus in OCI, unless what? To the extent that there is not enough surplus to take the hit, and in that case you bring the excess to P&L as an expense. Take note of this. However, first time revaluation decreases go straight to P&L. They do not go and hit what? Revaluation surplus. That's by way of a quick summary. So here they are saying the property was revalued to 45 million. On which date? Watch carefully. On 31st July 2019. So let's ask ourselves, which day are we at right now? We are currently at what? 1st August. That's when we bought the property. We've depreciated for 1 year. So from 1st August to 31st July, it's 1 full year. So it means that let's find what? Let's find the carrying value or the net book value of the asset as at what? As at 31st July 19. So that will be the cost, which we found here to be what? 32 million, right? So the cost is 32 million minus the depreciation, which we have found already to be what? 1.6 million, right? So 32 minus 1.6 gives me 32 minus 1.6 will give me 30. So Ghana cedi 30.4 million. So this is my carrying value as at what? 31st July 2019. And the question is telling me that the property on this date was now revalued to 45 DH million. Now I need to translate that 45 DH million into what? Ghana cedi. Which rate do I use? Then come here, watch carefully. Remember I told you non-monetary items at fair value. What rate do you use? You use what? The rate on the date that the fair value was what determined. So remember, honestly, to be very honest with you, if you know these three things I spoke about here, 1, 2, 3, and you know functional currency, presentation currency, nothing to ask you in this FR paper will beat you, because all the complex things will now move to level 3, corporate reporting. But your level, this is all you need to know, really, to be honest, right? So please make sure you master this. So here I've told you that if it's a revalued amount, then you use the rate on the date the revaluation was done. Here they are saying what? Revaluation was done on 31st July. So we just come here and we pick this last rate here, 31st July. 1 cedi was what? 1.125 DH. So we use that figure to do the translation. So next thing we'll do is what? Translation of revaluation. So we say revalued amount in DH equals what? DH 45 million. Then we say what? In Ghana cedi, this becomes what? I've done it up there already. I know I have to divide by the Ghana cedi figure. Let's not waste time. So it becomes what? DH 45 million divided by what? Divided by what? 1.125, which is what we have over here, right? So 1.125. What would that give you? So 45 divided by 1.125 gives me 40, right? So this gives me 40 million Ghana cedi. So it means this is the revalued amount in Ghana cedi. So going to IFRS 16, I'm now going to compare a carrying value of 30.4 million, which has now been revalued to what? 40 million. Now I can say I'm comparing apples and apples and not apples and oranges, right? So if this is the case, then let's now treat it according to what IFRS 16 would have said. IFRS 16 says that where there's a revaluation gain, we need to report that revaluation gain in a revaluation surplus or revaluation reserve in equity, specifically to sit in what? Other components of equity or other comprehensive income. So here we will say there has been a revaluation gain determined as follows. What will that give us? So the revaluation gain equals what? 40 million minus the initial amount of what right here? 30.4. So minus Ghana cedi 30.4. What is the difference? This gives me 9.6 million. So this 9.6 million is my revaluation gain. How do I treat revaluation gains? It's simple. The double entry is I will credit my revaluation surplus 9.6 million. Take note, this revaluation surplus is in OCI, right? Then I will debit what? The asset. In this case, what asset are we talking about? It is they just said property. So property with what? This 9.6 million. This is a double entry. Very important. If you know your double entry, please write it in the exam, right? It lets the examiner know you understand what you're talking about. And it can save you marks even when you get some figures wrong, because he knows you know how to treat the entries, even if you had the figures was correct. So please take note. State the double entry for a transaction when you can, right? So this is what we need to do in this question, 9.6 million. But what does the question say? It says what? How much you recognize in the statement of profit or loss and other comprehensive income. It is two things. So let me even do it this way. So we say in the statement of profit or loss, what do we recognize? Depreciation expense. If you remember, what did we get? Where is it? Good, 1.6 million, right? This figure. So an expense of what? 1.6 million, this Ghana cedi, right? This is an expense. Then in other comprehensive income, we have what? A revaluation gain of what we just found out is 9.6 million. This is an income item, or it's a gain, right? So you just let the examiner know this. If you can do this, you get 5 very, very easy marks. And that is it, right? If you can do all of this, you score 5 marks. So you can see it is not difficult if you know the rules in a particular standard. All the examiner is trying to test you is a certain particular principle in the standard. So the more you know the standard, the better you get, right? So please ensure you understand this through and through. Let's take our next question. So here, looks like an interesting one. Let's see what the requirement is. So let's go to the next page. Okay, it's on IAS 36, impairment of assets. Another very common guy who almost always finds a way to appear in the FR paper. I don't know why the examiners love this standard so much. So here required, in accordance with IAS 36, impairment of assets, explain with justification the required accounting treatment in the financial statements of Pusiga Limited for the year ended 31st December 2017. So we know this is going to be on IAS 36, impairment of assets. Let's read the question, and then I'll give you high-level overview of the standard to refresh your memories, and then we solve the question as usual, right? Applying the principles, of course. So what does the question say? Due to a change in Pusiga Limited's production plans, an item of machinery with a carrying value. So, in case you don't know, this is one key term in the standard. You see, because I am aware or I know what the standards say, when I'm reading a question on standards and I see a keyword, it just prompts my brain and I stop, right? So please, the better you get at the standards, the more these things become easy for you. And please, I keep saying, I'm encouraging all of us here to dedicate time between now and the exam date to doing questions on standards, to reading standards. Tell yourself that you're going to understand the standards so well that no matter what they ask you, even if you can't solve it, you can write something about the standard to get at least still 1 mark and move on, right? But don't say, oh, I saw a question on IFRS 16 leases. I didn't read leases, so I'll leave those 5 marks or those 7 marks. Never make that mistake, right? Every mark is valuable if you are desirous of passing. Yeah. So they due to a change in their production plans, an item of machinery with a carrying value of 11 million as at 31st December 2017. That's after adjusting for depreciation for the year, according to the question. Reviewed what? No, hold on. With a carrying value of 11 million after adjusting for depreciation. Okay, may be impaired. Great, impaired. So they are saying it's impaired. It's already been what? It suffered impairment due to a change in use. An impairment test, which was conducted on 31st December 2017, revealed that it's another key term. I couldn't help it, but my brain just froze and saw it, right? So reviewed its fair value less cost of disposal, another key term, I'll tell you about it shortly, was what? 5 million cedis. The machine is now expected to generate an annual net income of 2 million cedis for the next 3 years, at which point the asset will be sold for 2.4 million. Here they're giving information on something called value in use, which I'll talk about shortly. An appropriate discount rate is 10%. I'll need to do some discounting, so that's fine. Pusiga charges depreciation at 20% on what reducing balance method on their machinery. Then they are saying, note, the present value of an ordinary annuity of 1 Ghana cedi at 10% for 1 year, 2 years, and 3 years are 0.909, blah, 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 respectively. Then the present value of 1 cedi at 10% for 1 year, 2 years, and 3 years, they gave that to us as well. So all we are supposed to do is ask ourselves, what is this IAS 36 guy about? What must we know under this standard? And I'm going to summarize the standard for you and we move on with our lives. So IAS 36 deals with what? Impairment of assets. That's the name of the standard. Now, this standard is very easy to understand. When it comes to this standard, the whole idea of the standard is what? The standard seeks to ensure that an entity's assets are not carried at more than their recoverable amount. That is all. So, let me take this again. An asset is said to be impaired. Please listen carefully. If you know it is fine, just relax in your chair wherever you are. If you don't, listen carefully. An asset is said to be impaired if the asset is carried at more than recoverable amount. So if the carrying value of an asset is greater than its recoverable amount, then the asset is impaired. If you ever forget, just say if CV is greater than RA equals impaired. If CV is greater than RA equals what? Impaired. If the carrying value of an asset is greater than its recoverable amount, it is impaired. What this means is if an asset is carried, is valued, is held on the balance sheet at more than it can be recovered for, then it is impaired. Let me give you a simple example. This example is not fit for FR students, but this is how I explain to my little 1-year-old future accountant, right? So the point is, let's say you buy an iPhone, you walk into the Accra Mall, the Apple shop there, you buy the new iPhone, 12 Pro Max. Wait, yeah, 12, yeah, 12 Pro Max, right? And you bought the phone for, let's say, 8,000 Ghana cedis. You are excited, you take the phone out of the box, you are testing the phone. So you get to the car park of the Accra Mall. As you are testing the phone, your friend just comes to surprise you from behind. This way they blindfold you with their arms or their hands. And then out of shock, you drop the phone and you crack the screen. Something you bought for 8,000 cedis. The screen is now cracked and damaged into very tiny pieces. So a phone that was worth 8,000, do you agree with me that you can't sell it for 8,000 again? The highest you can sell it for is probably 4,000. And even that is because it's an iPhone 12. So this is impairment, ladies and gentlemen. It's not depreciation. Depreciation arises because you have used it, right? So we say it's depreciated out of what? The fraction of time. But here, an asset is impaired because you can no longer recover, you can no longer sell it for what it was initially worth. So in this case, the carrying value of the iPhone is 8,000. That's how much you bought it for. But how much can you recover it for? Just 4,000. So because the carrying value is greater than recoverable amount, we are saying that the iPhone is impaired by what? 4,000 cedis, right? This is an example I'll give my 1-year-old nephew, not you guys, but this was to drive the message home. So now that we know this, that the principle is if CV is greater than RA, then an asset is impaired. Let's continue. So we know carrying value. Carrying value is the same carrying value you know. So according to IAS 16, carrying value would ordinarily be what? The cost, if it's an IAS 16 asset, or if it's a revalued amount, then it's going to be the revalued amount. Revalued amount, which would have been what? Ordinarily, this would be under IAS 16 revaluation model. less accumulated depreciation, less accumulated impairment loss. So carrying value is the same thing you already know, right? How much the asset is carried on the balance sheet. But what is recoverable amount? That's probably the new thing for you here. Recoverable amount is the higher of two things. So it's the higher of two things. The higher of fair value less what? Cost of disposal and something called value in use. Fair value less cost of disposal is simply the fair value of the asset as determined under IFRS 13 fair value measurement, which says that the fair value of an asset is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date, right? So that's the fair value. Then you deduct the cost of disposal. How much will it cost you to sell this asset? How much will it cost you to realize it? Must you pay any agents to advertise? Must you incur legal fees? So you deduct the cost of disposal from the fair value, and that gives you what? The fair value less cost of disposal. Value in use is the present value. So let's even say is the discounted present value of what? Future cash flows associated with what? The asset, or that will be expected to be derived from the asset. So take note, you pick the future cash flows and discount them to present value. So I'm sure you understand why they give us these discount factors here now, right? It was for us to find the value in use. So the higher of value in use and fair value less cost of disposal give recoverable amount. Then you compare that to the carrying value of the asset. If the carrying value is higher, then the asset is impaired. The difference is impairment loss you write off to P&L. If recoverable amount is higher than carrying value, then the asset is not impaired. You don't need to do anything. So take note, if the reverse of this applies, i.e., if instead of carrying value exceeding recoverable amount, if recoverable amount is rather higher than carrying value, then there's no impairment. That's the normal thing, right? You expect your assets to cost what? Less than how much you can sell it for. Do you get it? So that is impairment in a nutshell. There's something called cash generating unit, but we will treat it if we meet a question on it, right? So for now, let's come back here so we can focus on what is being tested here, right? But before we even move on, let me give you a quick summary. A cash generating unit really is defined in the standard is defined in the standard as what? The smallest identifiable group of assets that generate cash flows that are largely independent of the cash inflows from what? Other assets or group of assets. So if you have any group of assets that on their own or in and of themselves they are able to generate their own cash flows, then they are deemed to be what? Cash generating units, and are required to determine their impairment on that group level basis, right? So let's come back to this question. They are saying that due to a change in their production plans, the carrying value is 11 million. So you can see here, they didn't give us cost for us to do depreciation, blah, blah, blah. And to even be clear, they told us clearly that this is what? After adjusting for depreciation. So you know this is the final carrying value you use. Don't bother deducting depreciation again. If you do that, you have what? Double counted. So let's say that here, this is question 2B. Question 2B. So this was from November 2018. So here, the carrying value equals what? 11 million. No problem, right? We know that we need to compare two things, right? We need to compare our carrying value and our recoverable amount. I said recoverable amount is the higher of two things: fair value less cost of disposal and what? Value in use. So let's find fair value less cost of disposal. Let's find value in use, and let's pick the higher to become what? Our recoverable amount. Easy, isn't it? So what is our fair value? So let's even say recoverable amount equals what? Higher of fair value less cost of disposal and what value in use. Please, in the exam, write the full thing. Me, I can do this, not you, right? Please write the full thing. Don't be doing this with your examiner. He's not your friend like that. Okay. All right. So let's find the fair value less cost of disposal. This was given to us for free. They said what? Watch it carefully. An impairment test conducted revealed that what its fair value less cost of disposal was what? 5 million. So they gave us this figure for free. This is 5 million. So now we need to find what? Our value in use. And I told you value in use over here is what? Is the discounted present value of future cash flows. So I need to do some small time value of money here. Okay. So here, let's go back to the question. They are saying the machine is now expected to generate an annual net income of 2 million for the next 3 years. So let me do some small time value of money graph here. This is year 0, which is what? Now, today. This is year 1, year 2, and year 3. They are saying that the assets will generate an annual net income, please, it's income, so it's inflow, of 2 million. So it means here, there will be 2 million here, another 2 million here, and another what? 2 million here. So we have 3 cash flows. And because they are equal amount over a period of time, we call this an annuity. So please, if you've not done financial management yet, I'm sure you even do this in what? Is it costing? What do you guys call it now? Back then, we didn't call it that anyway. So yeah, an annuity is what? A series of equal cash flows over a period of time, right? If it's for forever, then it's called a perpetuity. But here, it's an what? Annuity. And we have annuity due, and we have what? Ordinary annuity. Annuity due is when the payments are made at the start of the period. Then ordinary annuity is when the payments are made at the end of the period. And you can see the examiner told you what? The present value of what? Ordinary annuity. So he gave you discount factor for ordinary annuity because what these payments were made at the end of the year, or the cash flows occur at year end, right? So 2 million for the next 3 years, at which point the asset will be sold for 2.4 million. So it means in year 3 you get another cash flow of what? 2.4 million, right? So there are 3 cash flows here. 2 million, 2 million, 2 million for 3 years. And then in year 3, instead of just getting 2 million, you get 2 million plus 2.4 when you sell the asset. So 3 cash flows. Now, there's a formula to compute present value. So present value equals future value over 1 plus r to the power n. But you don't need that because the examiner give you what? Discount factors all over here. Annuity, you don't want to know it, right? Present value equals what? 1 minus 1 plus r to the power n all over n to the power, some nasty formula, forget about it, right? Let's use the discount factors we were given here, and that should suffice. So we say value in use equal what? Equals the present value. So we say, let's find the present value of the annuity. So present value of annuity will be what? They are saying 2 million cedis for 3 years, right? So come here, watch carefully. The examiner give you the present value factor. So you don't need to do any calculation, just use this figure and multiply. Of ordinary annuity at 1 CD at 10%, so it's the same rate here, right? 10%. For 1 year, 2 years, and 3 years are what? 0 0.9, 1.7, 2.48. So we'll pick 2.48 because that is for 3 years. We have a 3-year cash flow, right? So we'll pick the 3-year factor. So we multiply this by what? 2 point, what is the figure? 2.487. So let's multiply 2. So 2 times, give me a second, let me pull up my calculator. 2 times 2.487. That gave me 4.974. So Ghana CD 4.974. Then I'll now find the present value of what? A single cash flow. Because remember, I had what? 2 million, 2 million, 2 million. Annuity, right? Then 2.4. What you could have also done is you could have done 2 million 2 million, a 2-year annuity, then you discount this whole figure as one figure to present value. There's no formula for time value of money. What works for you, right? This is what I'm doing, but you get the same figure, right? So it means we have to now discount the 2.4 million, this one alone, right? This figure here to present value. So for that, the figure is what? 2.4 million. Because it occurred at what? Year end, year 3, we'll come to the present value, not of an annuity, right? Present value of 1 CD for 1 year, 2 years, 3 years. 3 years is what? 0.751, right? We'll pick times 0.751. So this gives me 2.4 times 0.751 will give me Ghana cedi 1.8024. So to find my value in use, it will be the sum of what? 4.974 and 1.80 whatever. So this plus 4.974 will give me, what does my calculator say? 6. I got 6. So Ghana cedi, I got 6.7764. So this is my value in use. Then, ladies and gentlemen, I say, therefore, value in use equals Ghana cedi 6.7764. I need to compare two things, right? I need to compare what? Value in use, right? This, and then my fair value less cost of disposal. What was that? That was what right here is what? 5 million. Then I pick the higher of the two. So I say fair value less cost of disposal equals what? 5 million. Clearly the higher is what? The value in use. So we say, since value in use is the higher of the two, then recoverable amount equals what? The value in use, which equals what? Our 6.776, right? 4. So if our recoverable amount is what? 6.7, then we need to ask ourselves, okay, we know this figure to be what? 6.7. What do we need to compare it to? We need to compare it to the carrying value, because remember I told you what? If carrying value is greater than what? Recoverable amount, then it is what? The asset is impaired. So let's go and pick our carrying value. I think they told us is 11 million. Where are you? Yes, right here. Carrying value is what? 11 million. So let's come here. So we say carrying value equals 11 million cedis, Ghana cedi, right? Recoverable amount equals what? How much? 6.776. Asset is what? Is impaired by the difference of what? 11 minus 6.776. That'll give us what? Give me a second. Minus 11 will give me 4.2236. So Ghana cedi in millions, 4.2236. This is my impairment loss, right? 4.2236 is my impairment loss. So how do I treat this impairment loss? Let's do the double entry. Impairment loss is written off to P&L as an expense, and the corresponding entry is a reduction in the value of the asset. So we say technically the asset is written down for impairment loss, right? So all we'll do is what? We will debit impairment loss. It's an expense in profit or loss by what? We got 4.22. That's enough. Then we credit what? The asset. So here they said it's a machinery. So we credit the machinery with 4.22 million. Right? And that is it for impairment. So this IS 36, I think this has done a great job of kind of like letting us know high level what the standard is about, how do you record, and what are the rules, right? So remember, when an asset is carried at higher than its recoverable amount, then we say that asset is impaired. Let's move on to our next question. So for our next question, question 3, this was taken from May 2018, was question 2E. And you can see here it's not saying calculate anything, but I chose it so that we can learn the standard, right? So it's saying identify any 2 criteria to be met before an asset can be classified as held for sale. So the question is saying, in accordance with IFRS 5, non-current assets held for sale and discontinued operations, a non-current asset or a disposal group is classified as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. So this is, they picked it word for word from the standard. This is what the standard says. Then they're saying, however, to qualify to be classified as held for sale, a detailed criteria must be met. Required, identify any 2 criteria to be met before an asset can be classified as held for sale. So let's go to IFRS 5. Let me summarize this for you. By the time we are done, we'll have answered this question, right? So fair deal. So for IFRS 5, which is what? Non-current assets held for sale, and then what? Discontinued operations. IFRS 5. What does this standard talk about really? What's the whole point? What's the fuss here? So IFRS 5, right, gives us the rules on how to account for non-current assets which are held for sale or held for distribution to owners, quite minor in general, right? So at the very fundamental level, assets which are held for sale are not depreciated. So first thing you need to remember is that once you designate a non-current asset as being held for sale, you do not depreciate. So please learn this. Do not depreciate. Once you meet the criteria to designate an asset as being held for sale, a non-current asset as being held for sale, number 1 is what? It is not depreciated. Number 2 is that it is measured at the lower of 2 things: the carrying amount and the fair value less cost to sell. I'll take that again. Once you designate an asset as being a non-current asset which is now held for sale, then you don't depreciate, you stop depreciating, and then you now carry it at the lower of 2 things: the lower of what? The carrying amount of the assets, which is the same carrying amount, which is cost less depreciation less impairment, and what? The lower of that, and the fair value less cost to sell, right? Okay. And then you begin to present it separately on the balance sheet. So here what you need to do is you present it under what? Typically under current assets, because you are expected to sell it within a 12-month period, complete something called a sale program within a 12-month period. So what are the criteria you must meet in order to what? Say you have been successful in classifying your assets as held for sale? There are a number of them. And like I said, once I give you these points, by the time you are done, we would have answered, because they're asking for 2. We have more than 2 according to the standard. So if I remember correctly, for an asset to be deemed as held for sale, some conditions must be met, right? The first is that what? Management should be committed to a plan to sell. So management of the company must have committed. They have said, okay, we are 100% behind this plan. They should be committed to a plan to sell that asset. That's point number 1. Point number 2 is that what? The asset must be what? Available for immediate sale. So it's not when you find a buyer, then you say, oh, I left the asset at my mom's place. She's traveled. She'll come back in 2 weeks. Then that's when I'll go for the asset. No. Once you designate an asset as held for sale, it must be available for immediate sale. When you find a buyer today, can you sell it today? You must meet that criteria. So first point, what? Management must be committed to a plan to sell the asset. Number two is that the asset must be available for immediate sale. The next is that what? An active program to locate a buyer must be what? Initiated. So here, are they running newspaper adverts? Are they on radio making noise about the asset they want to sell? Have they put up billboards and signposts and signboards? Are they advertising on social media? Whatever. But there must be an active program to find a buyer, to locate a buyer for that asset. That's the third point that must be met. Then the next is that what? The sale must be what? Highly probable. Highly probable. And here, highly probable means that what? Within 12 months. Within 12 months of you classifying the asset as what held for sale, you should have what? Sold it. That's why we are saying it should be highly probable, such that you can conclude the sale within 12 months. Then the next is that apart from the active program to locate a buyer, we are trying to reiterate that the asset is what's being, so asset is actively marketed for sale, right? At what? Reasonable prices in relation to fair value. So it's actively marketed for sale at reasonable prices in relation to what? Fair value. Then really these are the main ones. We can even add a final one, which is what? That any actions required to complete the plan indicate that it is unlikely that what the plans will change or be withdrawn. So for an asset to be what? Classified as held for sale, take note, management should be committed to a plan to sell. The asset should be available for immediate sale. There must be an active program to locate a buyer. The sale must be highly probable, i.e., it must be sold. You must sell the asset within 12 months, which is why I told you classify the asset under what? Current asset. You remove it from non-current and you bring it to what? Current, and you don't depreciate. Then the asset should be actively marketed for sale at reasonable prices in relation to their fair value. Then actions required to complete the plan indicate that it is unlikely that the plans will change or be withdrawn significantly. So here the question is saying identify any two criteria. Let me use this. Two criteria to be met before an asset to be classified as held for sale. So ladies and gentlemen, any of these I mentioned, they said they want only two. So please learn these and get ready for this question if it shows up. It's a very simple topic when it comes to IFRS 5, which is specifically under non-current assets held for sale. All right. So our next question. Okay, our next question here is saying the required is explain how each of the above should be accounted for in the financial statements of Bosco. How many marks? Okay, 5 marks. For the year ended 31st April 2017, in accordance with IAS 20, accounting for government grants and disclosure of government assistance for 5 marks. So we have a question on IAS 20 on government grants, and I'll use this opportunity as always to tell you all you need to know really about this standard, and then we'll take it from there. So we have something on government grants. Let's read the question, and then I will give you your summary, and then we solve the question together. So this was from November 2017. I'm going a bit back. I think they have really good questions in the ODS, so let's solve those as well. So they are saying Bosco Aluworks Limited is a manufacturer and supplier of aluminium utensils for households. They have recently established a new facility in Kumasi. To help in this new operation, Bosco Aluworks Limited have secured a number of grants from the government of Ghana and are unsure how the grants are to be accounted for in the financial statements. The company has a year end of 30th April 2017, and all the following transactions took place at 1st May 2016. The first grant. They are saying Bosco Aluworks has been awarded a grant for 80,000 cedis to be received over 3 years in respect of providing employment to fresh graduates in the area. Next, Bosco Aluworks received a 5,000 Ghana cedi grant from the Ministry of Business Development for the initial training of new employees. Next, the company also received a grant of 120,000 cedis from the Ministry of Special Development Initiative towards the acquisition of a 600,000 cedi machine. The machine has a useful economic life of 8 years and is what? It has an estimated residual value of 60,000 cedis. Depreciation is charged on a straight line basis. So let's summarize IS 20. It's a very simple standard, trust me. Another one of the examiner's favorites. So IS 20 is technically called Accounting for Government Grants and the Disclosure of Government Assistance. So what does this standard really talk about, right? So this standard outlines how to account for government grants and other assistance from government. Government grants generally are recognized in profit or loss on a systematic basis over any period in which the entity recognizes expenses for the related cost for which the grants are intended to compensate, right? But if it is grants relating to assets, then you are required to set up the grant as deferred income, or you deduct it from the carrying amount of the asset and you depreciate. What do I mean? So there are two types of grants. We have grants relating to income, and the grants relating to assets. What does this mean? For grants relating to income, it means the government gave you a grant which was meant to compensate your expense. Let's say you spent money to do something, then they give you money to either reduce the cost, or sometimes you've not spent anything, but they just give you money to kind of like defray your expenses. Grant relating to assets is when you are given a grant to actually acquire an asset, or you're actually given an asset by the government. So this is known as grant related to assets. They are accounted for differently. But before you even account for them, the standard gives criteria, just two, under which you can go ahead and recognize the grant. So there must be a reasonable assurance that the entity will comply. I think that's something they've also been asking. Entity will comply with all conditions attached to the grant, right? And then the final one is that the grant will be received. So if you ever forget, just know that for government grants, there are only two conditions for you to recognize. The first is that the entity will comply with all conditions attached to the grant. Then the next is that the grant will be received. Now that we know the conditions under which you recognize a grant, how do you treat these two types of grants I've told you about? For grants relating to income, it's very, very easy. You just recognize them. So recognized as income in profit or loss, right? in the year in which the related expense is incurred. So you recognize it as what? Income in profit or loss in the year in which the related expense is incurred. So if you spend 10,000 CDs and the government says, oh, take 20,000 CDs to really defray your expenses, then the same year you spend the money, that's the same year you recognize the grant as income in P&L. Very straightforward. That's for grants relating to income. How about grants relating to assets? For that one, there are two approaches, right? Two possible approaches. Either you use the deferred income approach, or you actually what? Deduct the grant from what? The assets. So take note, it's either you recognize as deferred income or you deduct it from what? The assets carrying amount, and then you depreciate them together, right? What does deferred income mean? I'll show you what it means shortly. Set up a separate account and then you amortize the grant over the useful life of the asset. Technically, the two should give you the same answer if you are doing the right thing. So let's do the question really, and then let's see what this gives us. Okay, so let's look at, we are given three grants, right? First grant, they are saying Bosco has been awarded a grant for 80,000 CDs to be received over 3 years in respect of providing employment to fresh graduates. So this is clearly not a grant related to what? An asset. It's a grant relating to what? Income, right? So how do you recognize this? Simple. This will be what? Recognized as income in profit or loss for 3 years. Why? Because they gave you this grant to be receivable over a 3-year period, right? And this is for you to provide employment to fresh graduates. So it means we assume that what? The revenue accrues on an even basis over the 3-year period. So this will give us what was the figure? 80,000. This equals 80,000 divided by 3 years. That gives me 26,667. So every year I'll recognize what? Grant income of this figure, right? Very, very simple. So all you need to do is when you get a grant, you debit either cash or bank when the government pays you. So when the grant comes, that's how you recognize it. Then you credit what? Your, let's make it what? Grant income. So the figure is what? Every year, it depends. The government can give you 80,000 at a go, and then it's in your bank, so you credit your grant income, right? So here's going to be 26,667, 26,667. How do I know? They said what? This will be received over 3 years. So it means every year government will bring you 26,667 every year in that order, right? So when the grant comes, just take it straight to what? P&L as other income. It will knock off or offset any cost you may have what incurred with respect to what? Hiring fresh graduates. II is on what? They are saying Bosco Aloex received a 5,000 CD grant from the Ministry of Business Development for the initial training of new employees. It's very similar to the first one, except that here there's no 3-year thing. They just give you what? 5,000 CDs in 1 year, and that's it. So as usual, here to what? This will be recognized as what? Income in P&L for the current year. So once again, here to our debit my cash or bank, or if the government has promised you but they've not paid it here, you can also credit something called, let's say, grant receivable, right? The grant will come but hasn't come. Then you credit grant income grant income in profit or loss as income, right? With the figure of 5,000 cedis. Let's look at the third one, which is actually more examinable. I'm not saying these cannot come, but like it's a more common one. The company also received a grant of what? 120,000 cedis from the Ministry of Special Development Initiatives towards the acquisition of a 600,000 Ghana cedi machine. The machine has a useful life of 8 years and an estimated residual value of 60,000. How will I account for this? Remember I told you for grants related to assets, which this one is clearly one, I have two approaches. Either I use the deferred income approach or I deduct the grant from the cost of the assets or the current value of the assets and I will depreciate together. So let's do both approaches. You realize they're the same. So let's do approach 1, which is what? The deferred income approach. Here you set up a deferred income account. What do I mean? When the grant comes, so let's say you receive the grant of 120,000, right? So what happens? Set up deferred income account. So I'll debit my cash or my bank with how much? 120. Then I credit deferred income with what? Ghana cedi? 120,000. Once I've set the deferred income account up, then the next thing I need to do is to amortize that deferred income or amortize the government grant over the useful life of the asset. So I amortize the grant. So it's simply going to be what? The grant is 120,000 divided by useful life right here of what? 8 years. So divided by 8 years. That gives me 15,000 per annum, right? So every year I will take 15,000 to P&L as income. So the double entry will be what? I will credit what? Grant amortization. This is income in P&L, right? Income, other income of 15,000. Then I will debit the deferred income account of what? With 15,000. What that will do is that it will reduce this 120,000 here by 15,000 every year until the grant becomes zero at the end of what? 8 years, right? This is the amortization approach where you set up the whole amount in a liability account on the balance sheet, and every year you spread it out gradually over the useful life of the asset to P&L. So what that will do is to match the corresponding expense in P&L for which is intended to what? Compensate. Take note of this, right? At the same time, the asset that the government gave you will be what? Will be depreciated. So next thing is what? We will depreciate the asset. So this is simple. We know depreciation will equal what? Cost minus what? Residual value or scrap value over what? Useful life. So here, what is the cost? They told us what? Let me do this. They said the cost is what? If you can see right here, 600,000 Ghana cedis. So 600,000 minus what? Residual value of 60,000. So minus 60,000 divided by useful life of what? 8 years. So divided by 8 years. So 600 minus 60 divided by 8 should give me 67,500 per annum. So it means every year depreciation expense of 67,500 will be recognized in profit or loss as an expense, right? At the same time, we'll be recognizing income of 15,000 cedis right here, 15,000 every year as income. So you can see that even though you are expensing 67,500, you are getting a relief, kind of, right? There's an expense from depreciation of 67, then there's an amortization of what, 15. So what would the impact be, right? What would the difference be? So let's try and find the net. This is just for comparison purposes. I'll show you something. So what will be the net impact? It will be what, 67,500 minus what, 15,000, right? So let's try and find out. So my calculator, minus 15,000 will give me 52,500. So take note of this figure, right? We'll come back to it. When I net off my depreciation and my grant income, I get 52,500 expense, right? Now, so this option one. Remember I said option one is what you set up what deferred. You set up what a deferred income account, deferred income approach. So here, when the money comes from the government, you debit your cash or bank with 120,000. You credit deferred income. It's a liability account on the balance sheet. Then you amortize this same grant, 120,000, over the useful life of the corresponding asset is meant to what, acquire. So here in the question was 8 years, so I divided what by 8 years and I get 15,000 every year. So every year I debit deferred income, that liability account, to reduce it by 15,000. Then I take what, the 15,000 to P&L as what, other income. Then at the same time, the asset that was given me or that I acquired with a grant, I would depreciate that asset. And here, it gave me 67,500 every year. And this is the deferred income approach. Approach number two is to deduct the grant from the cost of the asset. When the grant comes, you deduct what from the cost of the asset. So here, let's use what? Approach two, which is what? To deduct from the carrying value of the asset. So here's quite straightforward, right? So if you're going to deduct from the cost of the asset, when the grant comes, this is what you do. So obviously, when the grant comes, I will what? I will debit what? Cash or bank. How much was the grant? It hasn't changed. I'm just changing the approach. This was 120,000. So 120,000. Then instead of crediting deferred income, what, I credit the asset directly. So I credit the assets, 120,000. This credit will go and reduce the asset value by 120,000. So if you watch it carefully, what was the cost of the machine? 600,000, right? So cost of assets will reduce. It will now become 600,000 minus the grant of 120,000. I didn't defer it. I took it from the asset cost directly, right? So difference is 600 minus 120. That will clearly give us what? 480,000. Now this 480,000 is what you will now depreciate because you have what? Deducted from the cost of the asset. So we say, as usual, depreciation will still be what? Cost minus what? Residual value over useful life. So our cost, don't forget, is no longer 600,000, it's now what? 480,000. So cost of 480,000 because I've deducted the grant minus residual value hasn't changed. Here is 60,000. So minus 60,000 divided by useful life of what? 8 years. So it becomes 480,000 minus 60,000 divided by 8 years will give me 52,500. Do you remember this figure here? 52,500. Same figure here, right? So when you set up as a deferred income and you amortize over the same useful life as the asset, that's option one. And then at the same time, obviously, under option one, you still depreciate the asset. And option two is what? Deduct the whole amount of the grant from the cost of the asset, and then you depreciate over the useful life. You get the same answer. So here the examiner is liberal. Anyone that works for you, use it, they'll mark it correct for you, because the standard actually gives you two options. But please, one thing you should not do is don't do both approaches, because it doesn't give you any extra mark. You just waste valuable time you could have used to do another question to pass the exam. So this is it for government grants. Remember, quick recap, under government grants, what is the principle? That grants will be recognized when what? An entity will comply with all the conditions attached to the grant, and then the grant will actually be received. And then we have two types of grants under IAS 20: grants relating to income and grants relating to what? Assets. Grants relating to income are grants that are meant to compensate a certain expense. Once those grants are received, they are recognized as income in P&L in the year in which the related expense is incurred. Grants related to assets can be treated in two ways, but really they are meant to what? Help you acquire an asset or construct your own asset, whatever. The two approaches are the deferred income approach and what? The deduction from carrying amount of the asset approach. Under the deferred income approach, you what? Set up something called a deferred income account, and you amortize that grant over the same useful life as the asset it relates to. At the same time, every year, you will debit the deferred income account to reduce that amount, because your goal is that by the time 8 years have come in this particular case, or by the time the useful life of the asset is here, the grant should be zero, because you'd have spent everything, right? So you spread it over the same useful life, and then you credit what? P&L with what? Other income. At the same time, you depreciate the asset over its useful life as normal, and that will give us 67.5 in this case. So the net of the two, which I found here, which is what? This is the expense and this is the income, gave me a net expense of 52,500. Option 2 is to not bother with your whole deferred income, whatever. You go straight to the point and say, I will deduct the grant, I'll deduct from the carrying value of the asset. In this case, when the grant comes, you debit cash or bank, or if it's yet to come, you debit grant receivable, and then you credit the asset directly to reduce it by the value of what? The grant. What this will do is that the cost of the asset will reduce by what? The extent of the grant. So whatever I get as difference here is what I'll slot into my depreciation formula, and then I'll depreciate this 480, obviously take out my what? Residual value over useful life, and I get this 52,500, which is the same as this figure here if I had set up my deferred income approach. So if you use this approach, I mean, if you know this framework in your mind, nothing will beat you government grant, because it's either going to be a grant relating to an expense, or I mean grant relating to income, or a grant relating to an asset. So this is it for government grants, really. If you have any question, please leave it in the comments section. Let's take another question on IAS 37 provisions, contingent liabilities, and contingent assets. So let's look at this one on provisions, contingent liabilities, and contingent assets under IAS 37. Now, after this, I'll begin to mix things up a little bit. I'll bring in some questions from the ACCA so that we begin to even look at multiple standards within a shorter period of time. So we'll look at multiple questions from the ACCA, a number of ACCA past exam questions, as well, to broaden our scope of understanding. So back to this question. This particular question was from the May 2017 sitting of the ICAG financial reporting paper. They hadn't tested a question of this nature in quite a while, so I had to go a while back to bring this for us to run through. So here was the requirement. They said, for 3 marks, you're required to demonstrate how the company should record the cost of the site reclamation as at 31st August 2015 in accordance with IAS 37, which deals with provisions, contingent liabilities, and contingent assets. And then the II part says that you need to explain how the company should treat the effect of the earthquake in their financial statements for the year ended 31st August 2015 in accordance with IAS 10 events after the reporting period. Those of us who were here with us on Thursday on day one of the crash course, you are aware that we covered IAS 10. We looked at types of events, adjusting events, and non-adjusting events. So please, if you missed day one, do well to watch the replay of that, and then you should be able to get this covered. So let's read the question. And as usual, when we are done, I'll run you through what IAS 37 covers at a very high level so that you have a framework to work with in your mind. So let's read the question. They said Akapo Limited obtained a license free of charge from the government to dig and operate a gold mine. Akapo Limited spent 6 million cedis digging and preparing the mine for operation and erecting buildings on site. The mine commenced operations on 1st September 2014. The license requires that at the end of the mine's useful life of 20 years, the site must be reclaimed, all buildings and equipment must be removed, and the site landscaped. At 31st August 2015, Akakpo Limited estimated that the cost in 19 years' time of the removal and landscaping will be 5 million cedis, and its present value is 3 million cedis. On 31st October 2015, there was a massive earthquake in the area, and Akakpo Limited's mine shaft was badly damaged. It is estimated that the mine will be closed for at least 6 months and will cost 1 million Ghana cedis to repair. Required, demonstrate how the company should record the cost of the site reclamation as at 31st August 2015 in accordance with IAS 37 provisions, contingent liabilities, and contingent assets. So, like I always do before we start, let me take you through what IAS 37 you need to know high level. What is the standard about? Let me give you something to work with in your mind as a framework. So, as the name implies, the standard is called what? Provisions, contingent liabilities, and contingent assets. So let's run through all of them one by one, and then we'll look at the accounting treatment. So let's start with provisions. Provisions. What must you know about provisions? It's simple. The standard defines a provision as a liability of uncertain timing, or amount. So first of all, take note that a provision is a liability. So any liability where the timing or the amount involved, so the time it will occur or the amount involved where it's uncertain, right? Then we deem that to be a provision. So take note, a provision is essentially what? A liability of uncertain timing or amount. As long as the timing is uncertain, you are not sure when the time of the liability will occur, you're not sure of the amount involved, then you say it's a liability. What does the standard say about liabilities? You need to, what do they say about provisions? You need to recognize a provision when you meet 3 criteria, right? And if you want to remember, you can use an acronym, either ROP, or you can use what? POR, right? ROP or POR to remember, right? So what does this stand for? Now, for you to remember, the first P, so let's even go with the POR, right? So our P, what does it stand for? Our O, what does it stand for? Our R, what does it stand for? The P stands for what? Probable. The O stands for obligation. And the R stands for what? Reliable estimate. So, ladies and gentlemen, for a provision to be recognized, just put it in your mind somewhere that you need to meet POR. If you meet POR, then you can recognize a provision. What does it stand for? So the P is what? It should be probable that what payment will occur, or it should be more likely than not that payment will occur or the liability will be settled. That's a probable. The O, which is obligation, is that what? There must be a present obligation, either a legal obligation or something called a constructive obligation that must have arisen as a result of a past event, which is also known as the obligating event. And then R is what? Reliable estimate. It means what? The amount should be able to what? Reliably what? Estimated, or it should be reliably estimable. So anytime you meet POR, or if you want to do yours ROP, then you can recognize what? A provision. So take note, recap, a provision is a liability of uncertain timing or amount. To recognize the provision, you need to meet POR. Now, let's come back to the standard. It's provisions, contingent liabilities, and contingent assets. So, let's create, or let's even look at what contingent liabilities and assets are. As the name implies, contingent liabilities are not liabilities yet. Contingent assets are not assets yet. Contingent liabilities will become liabilities unless something happens, because the word contingent means it depends on something. It depends on something else happening. So to remember, contingent liabilities and contingent assets are neither asset nor liabilities. They will only become assets or liabilities based upon the future occurrence or non-occurrence of another event. So let me create a table here to help you guys remember how to treat contingent liabilities and contingent assets. So let me create a table here. So I have my contingent liability, contingent asset. So just memorize this table and you'll be able to answer any question on contingent liabilities and assets. So probable, possible, and remote. Okay, so I want to ask you guys a question. Probable and possible, which one is more likely to occur? So if I say it is probable that I will come to your house tomorrow, and it is possible that I'll come to your house tomorrow, which one is more likely to occur? Please type in the comments. Is it probable or possible? Which one is more likely to occur? Do you think it's probable or possible? Or if we say the NPP or the NDC is, or the chances of the NPP winning the 2024 election is for more probable than possible. Which one is more likely, right? Is probable likelier to happen than possible? If I say it is probable that it will rain tomorrow, and if I say it is possible that it will rain tomorrow, which one would you say is more likely to happen? Please type in the comments. Either just type probable or possible. Which one you think is more likely to happen, right? Let's look at some answers that we have so far. Okay, so if you ask me, probable is more probable than possible, right? So probable has a higher likelihood of occurring than possible, right? Possible is it could not, but probable has passed the threshold of 50. Probable is more like, you know what, I'm not saying it's virtually certain. I'm not saying it's definitely going to happen, but it is likelier to happen than the possible. Possible is it's possible it will rain. It could rain, it could not rain. If I say it's probable it could rain, then I'm not saying 50-50. It's probable. Like there's some level of some assurance, right? You're not too certain, but it's probable it will happen. There's some chance, there's some probability, right? So probable is more likely than possible, even according to the IFRS, right? So Why am I saying this? I want you to use this table in your mind to learn how to treat contingent liabilities and contingent assets. So what the standard says is that for contingent liabilities, they must be disclosed when the likelihood of the event occurring is probable and possible, or probable or possible. But if the occurrence likelihood is what? Remote, then you do not disclose, you do nothing. I'll take that again. For contingent liabilities, when I tick here, so that the legend or the keys that when I tick, it means what? Disclose in notes. If I do the cross, it means what? Do nothing. Don't disclose, don't recognize, don't do anything, ignore it. So for a contingent liability, if the chance or the likelihood of occurrence is assessed as being probable or possible, please disclose it in the notes. If we say the chance of it happening is very remote, which means it's very unlikely, then do nothing. However, for a contingent asset, you only disclose in the notes when the likelihood is probable. If it is possible, you do nothing. If it is remote, you do nothing. So take note, contingent liability, you can memorize it this way. On the left-hand side, you have probable, possible, remote. At the top, you have contingent liability, you have contingent assets. Then you learn that contingent liability has 2 ticks. Contingent assets has just 1 tick, right? Remote, both of them, you do nothing. So what that means for you is that you know that for a contingent this is how you read the table. For a contingent liability, it will be disclosed in the notes when the likelihood of occurrence is either what? Probable or possible. If it is remote, you do not disclose, you take no action. Then, however, contingent assets are only disclosed in the notes if the likelihood of occurrence is what? Is probable. If the likelihood of occurrence is either possible or remote, you do nothing. This is what the standard says, really, right? So I've kind of used what the standard says to create a table. So just have this table in mind, and you know you can treat anything they ask you in the exam when it has to do with contingent liabilities and contingent assets. Once again, let me recap. Contingent liabilities and contingent assets are not assets or liabilities. They'll only become assets or liabilities based upon the future occurrence or non-occurrence of a specified event, right? Something must happen before, it must be conditional on something happening before they can be triggered, right? So back to the question. Even though the question doesn't have to do with contingent liabilities and contingent assets, I use this chance to help you revise your IAS 37. This question really has to do with what? Provisions, right? So back to the question, what are you required to do here? It's quite simple. And here they've done all the work for you, for those who know what I'm talking about. So somebody has a license to dig and operate gold. They spend 6 million in digging. They started mine operations on 1st September 2014. Their license gives it 20 years useful life. You know, there's this thing where for entities that are into the extractive, so either mining and oil and gas, when they are done, they are required to do something called rehabilitation, or in some cases, decommissioning, right? Now, these expenses are in a way that they put aside money so that when they are done with their operations, they are able to restore the environment to its natural state and then reduce the impact of the damage they may have caused. So what the standard says is that when it comes to such amounts, they are required to discount those future payments into a present value. And that present value figure is what will be recognized in the books as the value of the provision. And then IS 16 on property, plant, and equipment even requires that in some cases, the amount or the debit entry of the provision will be as part of the cost of the asset. So you will discount these future cash flows to present value and add it to the cost of the asset, and then you depreciate over the useful life of the asset. And then you unwind the provision such that by the time the obligation to decommission or rehabilitate the environment arises, you would have gone back to the future value amount, which is payable at the future date. But here, like I said, they've done the work for you, because they are saying that At 31st August 2015, they estimated that in 19 years' time, the cost of what removal and landscaping will be 5 million. That's in future, but its present value is 3 million. They've done the discounting for you to 3 million. So the present value of 3 million is the provision. Take note, I told you, if they didn't discount for you, the question would have given you an interest rate or a discount factor for you to use to discount the 5 million to present value. But here, it's a gift. They've given you the present value of 3 million. So your answer is what? 3 million, right? So they're saying, how should you record the cost of reclamation? The answer is that what the 3 million is the present value of the future amount, and that will be the amount recognized in the books as the provision for what? Reclamation cost. So all we'll say here, give me a second, is that okay. So here, IAS 37 prescribes the accounting treatment of provisions. Then I'll say what? The cost of the site reclamation as at 31st, I almost wrote December, 31st August 2015 will be based on the present value of the future amounts required to carry out the site reclamation activities in 19 years' time. Then we write this cost in 19 years' time is given as 5 million Ghana cedis with a present value of 3 million cedis, right? So we'll say the 3 million cedis is therefore the amount to be recognized as a provision. Then we'll say also in accordance with IAS 16, property, plant, and equipment, this provision amount will be recognized as part of the cost of the corresponding asset and depreciated over the useful life of that asset. We say the double entry is as shown below. So if you don't know this, I'm telling you, double entry, we say how I learned accounting is all provisions have credit balances, every single provision. So it means what? I'll credit my provision for site reclamation. The figure is what? 3 million cedis. So Ghana cedi 3 million. Then I'll debit the corresponding, so non-current assets of what? 3 million. If you can do this, you score 3 marks here, right? Easy 3 marks. They're saying demonstrate how they record the cost in accordance with what? IS 37, and that is what we have done. Like I mentioned, going forward in future years, you need to unwind this figure, this 3 million figure. So you unwind it with the finance cost. But in this question, we're not given any interest rate. But if you were, you would have had to unwind it every year, such that by the time you get to 19 years, you are back to what? The initial 5 million amount given you here, right? So that's it. They're talking about explain how they should treat the effect of the earthquake in their financial statement in accordance with IAS 10. Like I said, we treated this on day one, so please take a look at that. But let's run through quickly and let's not waste time on a small standard like this. So they are saying on 31st October 2015, there was a massive earthquake in the area and their mine shaft was badly damaged. It is estimated that the mine will be closed for 6 months and will cost 1 million to repair. So the question is this an adjusting event or a non-adjusting event? That's all they're asking you. So here all we need to do is ask ourselves what's the year end and when did the event occur. So first thing is what the year end is 31st August 2015. When did the earthquake occur? 31st October 2015. You all agree with me that what? October comes after August, right? So it means this is an event that occurred after year end and before the financial statements were authorized for issue. So this is clearly what an event after the reporting period. Adjusting or non-adjusting, it is a non-adjusting event. Why? I told you on day one that usually these acts of God, here they said were massive earthquake, right? Nobody saw this coming. This massive earthquake is not indicative. It doesn't give you further information about conditions that existed as at year end. So because of this is clearly what? A non-adjusting event. As a non-adjusted event, how do you treat it? You are required to what? Disclose the effect of the non-adjusting event in the notes to the financial statement if it is what? It is material. But you do not adjust the financial statement for non-adjusting events. So that's it really. Let's not waste time on this. Like I said, if you want my detailed overview of the standard, I went into quite some detail. Please check our day one recording if you were not here with us. Let's come to what I'm more excited about. Let's look at some ACCA questions. Let's use this as a chance to refresh our knowledge about different standards across board. So the first one we look at is IAS 40 on investment property. I'm sure you're aware the ACCA uses multiple choice exams to test a large portion of their financial reporting paper. So I think it's a good way to test students to understand that. So here I want all of us to participate, right? So all you need to do is look at the question number. So here's question 6, right? So you just look at the question number and then you type the corresponding answer in the let's do it. Let's use the live chat, right? Or anywhere you want to type your answer, either the comments or the live chat. So if let's say you want to say question 6 is, let's say A, you just type 6 and then what? A, right? We'll be doing multiple questions, so don't just type A, B, or C, or D. It will confuse those who want to follow, right? Just type 6A. If you think it's B, just type 6B. If you think it's C, just type 6C, in that order, right? So we'll do it for the same order. I'll mention the question number, and then you type your answer, right? So this is question 6, right? Let's all get ready to type our answers. Which of the following properties owned by Scoop would be classified as an investment property? So here, this is IAS 40 investment property. Let me run through quickly. IAS 40 investment property says that what? Okay, give me a second. So this is IAS 40 investment property. It says investment property is what? Any what? Property that is what held for rental or for capital appreciation or for both. They are initially measured at cost and then what subsequently measured at what either the cost model or the fair value model. And the fair value model is not the same as the revaluation model under IAS 16, i.e., all fair value changes are taken to P&L directly, unlike the revaluation model where what changes in fair value are taken to what revaluation surplus in other comprehensive income. That is IAS 40 in a nutshell. And when you use the fair value model, you do not depreciate that investment property. So back to this question, question 6. Which of the following properties owned by Scoop would be classified as an investment property? Is it a property that has been leased to a tenant but which is no longer required and is now being held for resale? B, is it land purchased for its investment potential and then planning permission has not been obtained for building construction of any kind? Is it C, a new office building used as Scoop's head office, purchased specifically in order to exploit its capital gains potential? Or is it D, a stately home used for executive training? Which of the following is or will be classified as an investment property under IAS 40? So please type your answer 6A, 6B, 6C, or 6D, whatever you think the answer is. Let me give you a few moments to type that. Is it 6A, 6B, 6C, or 6D? And please don't look at what someone is typing. What do you think within your heart the answer is, right? So is it a property that had been leased to a tenant but which is no longer required and is now being held for resale? Is it land that is purchased for its investment potential and then planning permission has not been obtained for building construction of any kind? Is it an office building, a new office building used by the company as their head office, which is purchased specifically in order to exploit their capital gains potential? Or is it a stately home that they use for executive training? Which is your answer? 6A, 6B, 6C, or 6D? Okay, so let me eliminate the ones that are clearly not the answer. Look at the first one. They said a property that had been leased to a tenant, take note, but which is no longer required and is now being held for what? Resale. This will be identified or classified under what? IFRS what? 5, non-current asset held for sale. We looked at that yesterday. What is the clue? They said it's now being held for resale because they are no longer what's required. So this is not investment property. It is being held for resale. So it's under IFRS 5 and not IAS 40 investment property. So A is wrong. Let's look at B. B is saying land purchased for its investment potential. They bought the land for its investment potential. They have not yet obtained planning permission for construction of any kind. This looks very tangible, very likely. So let's mark it down. I'll come back to it. Let's see the other options. C says a new office building used as the company's head office. Purchased specifically in order to explain their capital gains potential. They brought this last part to confuse you. They bought it to exploit the capital gains potential, but as at now they are using it as their head office. And IAS 16 defines PPE as any property that is used in the production or supply of goods or services, or for administrative purposes. And here they are using it as their office. So this is going to be under IAS 16 as PPE. It's not investment property because they use it. It's called owner occupied property in this case, right? Here, the last one, a stately home, which is used for executive training. Here, they are using it in the production or supply of their own services. So it's also IAS 16, property, plant, and equipment. So it means the answer is B, right? Which is land purchased for its investment potential. Because remember, investment property is any property that you hold for either rental or capital appreciation purposes, or for both. So here they bought it for the investment potential. That's clearly the capital appreciation part. Okay, next question, question 7. Which two of the following statements about IAS 20 accounting for government grants and disclosure of government assistance are true? So here we have 4 answers. You need to choose 2 out of 4. So same format, you type either 7AB, 7AC, 7DB, 7CB, whatever the answer is. So you type the question number, which will be 7, and then you type 2 letters for your answer. So which 2 of the following statements about IAS 20 about government grants are true? Right? So first statement A. A government grant related to the purchase of an asset must be deducted from the carrying amount of the asset in the statement of financial position. I'll take that again. A government grant related to the purchase of an asset must be deducted from the carrying amount of the asset in the statement of financial position. Okay. B. A government grant related to the purchase of an asset must or no should be recognized in profit or loss over the life of the asset. I'll take that again. A government grant related to the purchase of an asset should be recognized in profit or loss over the life of the asset. C. Free marketing advice provided by a government department is excluded from the definition of government grants. Free marketing advice provided by a government department is excluded from the definition of government grants. And finally, any required repayment of a government grant received in an earlier reporting period is treated as a prior period adjustment. Any required payment of a government grant received in an earlier reporting period is treated as a prior period adjustment. Here, don't be shy. Please type your answer. 7AB, 7D, whatever. So type your number and 2 letters. Okay, so let's run through the answers. Let's start with A. A government grant related to the purchase of an asset must be deducted from the carrying amount of the asset in the statement of financial position. Because it said must, the answer is wrong. Why? Because what? There are two options. So yesterday when we did government grants, I told you we have two options when it comes to, not even yesterday, I think it's today, right? Yeah, so actually today, here they're saying the government grant must be deducted from the cost of the asset. No, it may. It's just one option, right? You either set up a deferred income and amortize over the useful life of the corresponding asset, or you can deduct. So here, because it said must, it is incorrect. Let's get the second one. A government grant related to the purchase of an asset should be recognized in profit or loss over the life of the asset. That is true. Why is it true? Because as I showed you today, whether you use the deferred income approach or you use the deducting from carrying value of the asset approach, both of them will result in what? The grant being in P&L in one way or the other, right? And it will be over the useful life of the asset. So B is one of the correct answers. Let's look at C. Free marketing advice provided by a government department is excluded from the definition of government grants. Yes, this is true. This is rather going to be called what? Government assistance. So you can see the standard is called accounting for government grants and disclosure of what? Government assistance. So when government gives you free marketing advice, it is not a government grant. It is simply what? A government assistance. So this is outside the scope of government grant. So the answer should be 7BC, right? 7BC. So all those who type 7BC, congrats to you. D is saying any required repayment of a government grant received in an earlier reporting period is treated as a prior period adjustment. No, it is treated as what? A change in estimate. So let me use this opportunity to revise or help you revise IAS 8, which deals with what? Accounting policies, changes in accounting estimates, and errors. So what IAS 8 says is that what? If it is a change in accounting policy, then this must be accounted for what? Retrospectively, which means you need to what? Restate prior periods and what? Restate earliest comparable what? Retained earnings balance sheet and all of that. So change in accounting policies are accounted for what? Retrospectively. Changes in accounting estimates are accounted for what? Prospectively. What this means is that what you just make the change, you effect the change in the current period and in future periods. So it's current and future. I don't go back. Then accounting errors are accounted for what? Retrospectively. So you can just memorize this, that what? Changes in accounting policy and accounting errors are accounted for retrospectively. Estimates changes are accounted for prospectively. So here, if there's a requirement to what? Repay a government grant in an earlier reporting period, it is not a prior period adjustment. You don't go and make any change in prior periods. You rather what? Make the estimate what? or you effect the change in current periods and future periods going forward. The next one is on IAS 36, impairment, question 8. So here we are saying, which of the following is not an indicator of impairment? Take notice, which of them is not which of them is, right? Which of them is not an indicator of impairment? A, advances in technological environment in which an asset is employed have an adverse impact on its future use. Let me take that again. So give me a second. Yeah, which of them is not an indicator of impairment? So you just type your answer. A, is it A, 8A, 8B, 8C, or what, 8D? So A is that what advances in the technological environment in which an asset is employed have an adverse impact on its future use. B, an increase in interest rate which increases the discount rate an entity uses. C, the carrying amount of an entity's net asset is higher than the entity's number of shares in issue multiplied by its share price. And then D, the estimated net realizable value of inventory has been reduced due to fire damage, although this value is greater than its carrying amount. So type your answer 8A, B, C, or D. Okay. All right, so let's run through the answers. So the first one, if there are advances in technological environment in which an asset is employed, right, and this has an adverse impact on its future use, then this is, right, it is an indicator of impairment. Because if technology has changed, it will require what? Some changes. So I'll take that again. If the technological environment in which you do business, there's an increase in tech, right, and you don't adapt, it's an indicator of impairment because you stand a chance of what entering into obsolescence because tech will advance faster than you and your assets may be impaired. So this is an indicator, so it's wrong. The question was what is not, right? The next is what an increase in interest rate which increases the discount rate an entity uses. This is also an indicator of impairment. Why? Because don't forget that it's an element called what? Value in use. And the value in use relies on what? Discount rate, which will bring it to what? Present value. So if there's an increase in that rate, then this will what? Impacts the value in use estimate, which was what? End up impacting the recoverable amount estimate. This can lead to what? Impairment. Then the next, the carrying amount of an entity's net asset is higher than the entity's number of shares in issue multiplied by share price. Shares in issue times share price equals what? Market value of the company or market valuation, right? So if your carrying amount of assets is greater than market value, then your assets are what? Impaired, or your business is impaired. What does it mean? You are carrying your assets at what? Book value, which is higher than market value. So this is clearly a case where what? You are impaired. This leaves us with what? Answer D as the correct answer, right? But why is D correct? D is saying the estimated net realizable value of inventory has been reduced due to fire damage, although the value is greater than carrying amount. Take note that I said an asset is impaired when what? Carrying amount is greater than recoverable what? Value. Here they are saying that what? The net realizable value of inventory is greater than the carrying amount. So despite the fact that it is what? It has been destroyed by fire. The trick here is that what they manage to tell you that what? The net realizable value is still greater than carrying value. This is not an indicator of impairment. It is not impaired despite the fire. Take note. Because when fire occurs, you must establish after you do your impairment test. IAS 36 says you must do an impairment test at least annually. And then when you do your test, you need to what? Estimate your carrying value, estimate your recoverable amount. And then in that process, you need to what? Estimate whether it's what is impaired. Here, we ended up seeing there's no indicator of impairment. So 8 is D. Next question. Which of the following gives the best description of the objective of financial statements as set out by the International Accounting Standards Board's conceptual framework for financial reporting? Is it, so type your answer as usual, 9A, 9B, 9C, 9D, right? So A, is it to provide all information about the reporting entity that users need? Is it B, to fairly present the financial position, performance, and changes in financial position of an enterprise? Is it C, to provide information about the value of the reporting entity to users? Or is it D, to provide financial information about the reporting entity that is useful to users in making decisions relating to providing resources to the entity? I'm sure we are all clear. The answer is obvious, right? Very, very obvious. But I'll give you some time to type. But the answer for number 9 is very obvious. Very obvious. The answer is yes. Anyone? Number 9 is what? Is it 9A, 9B, 9C, 9D? The answer is D, right? The longer one is the answer, almost always, if you are doing multiple choice. But here, that's the correct answer actually. To provide financial information about the reporting entity that is useful to users in making decisions and relating to providing resources to the entity. All right, the next one. According to IAS 8, so this is question 10, accounting policies, changes in accounting estimates and errors. How should a material error in the previous financial reporting period be accounted for in the current period? Ladies and gentlemen, the answer is here. Right here, what I just did here. Right? They are saying that for a material error in the previous, I didn't know it would come up, to be honest, right? But the answer is on the screen. So please, is it 10A, 10B, 10C, 10D, right? A material error in the previous financial reporting period, how should it be accounted for in the current period? A, by making an adjustment in the financial statement of the current period through the statement of profit or loss and disclosing the nature of the error in a note. B, by making an adjustment in the financial statement of the current period as a movement on reserves and disclosing the nature of the error in the note. C, by restating the comparative amount for the previous period at their correct value and disclosing the nature of the error in the note. Or D, by restating the comparative amount for the previous period at their correct value, but without the requirement for a disclosure of the nature of the error in a note. Is it 10A, 10B, 10C, or 10D? All of us can see from here that I said for what errors, they need to be accounted for retrospectively, which means you need to go back and make the change. So it means what? It is either going to be C or what? D, because they are the ones that are talking about by restating comparative amounts. But the difference between C and D is that C is saying that after you do the comparative restatement, you need to also disclose the nature of the error in the notes. D is saying that you don't have to without the requirement to disclose. The question said what? It's a material error. So please, material errors after adjustment, you must disclose so that your stakeholders are aware, the users of the financial information should be aware of this error. So the answer is C. You restate and then what? You disclose in the notes. Our last set of questions and we are done. These are on financial instruments, right? Let me test your understanding from what I taught you yesterday. So question 11, as usual, type 11A, B, C, or D. These are going to be very fast, right? So question 11, for a debt instrument to be held under amortized cost, it must pass two tests. One of these is the contractual cash flow characteristics test. What is the other test that must be passed? I taught you yesterday. I said there are two tests, right? So is it the business model test? Is it the amortized cost test? Is it the fair value test? Or is it the purchase agreement test? So question 11, type A, B, C, or D. This is very easy. If you were here yesterday, this is easy for you, easy chop for you. So 11 is what? Easy. It's 11A. Right? I told you yesterday that what? You must meet either the business model test or the contractual cash flow characteristics test. In summary, the business model test under IFRS 9 is what? Your intention to hold the asset onto what? Maturity. And the contractual cash flows characteristics test is your intention to hold the asset to collect the related cash flows on that particular financial instrument. So here, please take note. The answer is A, business model test. Next question, still on financial instrument. What is the default classification for an equity investment? Once again, I taught you this yesterday. What is the default classification for an equity investment? Remember, I told you to take that framework I taught you very seriously. If you have forgotten, please take a note. It helps to summarize financial instruments for you. That's what I've used to understand the standard all these years. So please do check that out if you're not here. What is the default classification for an equity investment? Is it A, fair value through profit or loss? Is it B, fair value through other comprehensive income? Is it C, amortized cost? Or is it D, net proceeds? So please type 12A, 12B, 12C, or 12D. What is the answer? 12A, 12B, 12C, 12D. What is the default classification for an equity instrument? All right. Yesterday I said the default classification is what? All equity instruments under financial assets are what? Held at fair value through profit or loss. That's the default, right? You only do fair value through what? OCI. When, what did I say? There is something called what? A strategic intent to what? Hold the asset until maturity. I told you this. But the default, the question is asking for the default. It is supposed to be what? Fair value through profit or loss. But what does fair value through profit or loss mean? It means what? Any changes in the value of the equity investment will be what? Recorded in profit or loss for the year. It won't go to other comprehensive income. Fair value through OCI is just an alternative. Amortized cost is also an alternative. Then net proceeds is really for what? Financial liabilities, right? Financial liabilities. Okay, next question. For which category of financial instruments are transaction costs excluded from the initial value and instead expense profit or loss? Once again, I taught you this yesterday in that same framework. So please, is it 13A, 13B, 13C, or 13D? So is it going to be 13A, 13B, 13C, or 13D? So for which category of financial instruments are transaction costs excluded, not included, excluded from the initial value and instead expense profit or loss? Once again, I did it yesterday. So is it going to be financial liabilities at amortized cost, which is A? Is it financial assets at fair value through profit or loss? Is it financial asset at fair value through OCI? Or is it financial asset at amortized cost? Remember I said I told you that what? Financial assets initially are recognized at fair value plus transaction costs default, unless, right, they are recognized at fair value through P&L, in which case what? Transaction costs are expensed to P&L. Those who were here, this is exactly what I said. Expense to P&L. So the question is saying that for which category are transaction costs excluded from initial value and instead expense? The answer is what? Right here, fair value through P&L. So the answer is what? B, fair value through profit or loss. So 13 is B. Right? We did this yesterday right here. Last question. Which of the following statements regarding IFRS 13 fair value measurement is not true? Now, this standard, let me quickly give you an overview. IFRS 13 fair value measurement. So IFRS 13 fair value measurement deals, as the name implies, it deals with what? Fair value measurement. It defines fair value as a price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It categorizes fair value into 3 levels: level 1, level 2, and level 3. Level 3 is actually what? Based on quoted prices in active markets. So when you go to the shopping mall, when they say it's 5 cedis, it's 5 cedis. It must be an active market. That's level 1. Level 2 is based on what? In most cases, what? Observable inputs for what? Similar or identical products, right? And level 3 are unobservable inputs. So level 3 is the most unreliable. Level 1 is the most reliable inputs, right? It's a broad standard. On this same channel, I have a summary video on IFRS 13, so you can look in the IFRS summaries playlist. You find a video on IFRS 13. It's very short. Okay, it's quite short. It's not lengthy. Take a look at it if you want to understand IFRS 13 a lot more. But just know the high level, level 1 inputs are more reliable than level 2, and level 2 is more reliable than level 3. But level 1 is the best, level 3 is the worst. So here saying, which of the following statements regarding IFRS 13 fair value measurement is not true at all? So 1, level 1 inputs are likely to be used without adjustment. Is it true or not true? It's true. I told you it's the best. And then what level 1 inputs are prices, quoted prices in active market. So you not adjust it in most cases. What they tell you it is what you use as a price, because it's the price on an active market with sufficient trading volume. So 1 is 14A is true. So it's not the answer. Next, level 3 inputs are based on the best information available to market participants and are therefore regarded as the most reliable. No, I just said level 3 is what? The most unreliable. So the answer is what? B. Level 3 inputs are the most unreliable. Most unreliable. So that means automatically C and D are correct, right? So level 2 inputs may include quoted prices for similar and identical assets and liabilities. I said it, right? So that's correct. Level 1 inputs comprise quoted prices in active market for identical. That's what I said as well, right? So that is it for IFRS 13. I recommend that you take a look at the video if you have time. So that should bring us to the end of day 2. What I'll leave you with is that please, between now and when you sit your paper, focus, create a steady plan that you are going to learn the IFRSs, right? We are going to really study them. You're going to really, really, really study the IFRSs. Make sure you go through them, make sure you understand them. Look at questions, right? Test yourself on the principles. Make sure you understand the standards, right? By the time we are done with this session, I'll take you through which ones you should focus your attention on in that order. So I'll catch you guys on Monday. On Monday, we are looking at consolidated financial statements. Please don't miss that. It's another must know area which will definitely be on your exam. So on Monday, we're starting with console. I'll see you guys on Monday. So as usual, if you have any questions, please feel free to leave them in the comments. I'll definitely get back to you. And please, if you love this video, smash that like button, and share this video within your network. We love your likes, right? If you love this video, hit the like button, and that will show that you are in love with our content. So yeah, on that note, let's bring today to an end. I will meet you guys on Monday for day 3 of the crash course. Enjoy your weekend and see you on Monday. Stay safe. Bye bye.